Well, thank you everybody for joining. We're excited to have Ryan Obenreder with us today. Ryan is a partner of Keeley and I's. I think we worked together maybe 4 or 5 years now. We love working with Ryan. He's an absolute expert in what he does. Super responsive. His an entire team. They're very responsive. Working holidays, weekends, they're awesome. But we've also just found that he is continuously looking for ways to help save us money and really protect our butt. And I think, insurance for investors, particularly rehabbers, small scale developers, it's just something that we really don't pay a lot of attention to or really don't know the details about, as Ryan and I discovered on a pre-call for this call. So it's all that more important to have an expert to work with and to join sessions like this where you can learn about insurance. So Ryan is the owner with his wife Tiffany of State Insurance. They're based here locally in the Tampa area. He's been 10 years in the business, but Tiffany and her family have 40 years of history in the insurance business. So insurance is in the blood in the Obenreder home. And I'll let Ryan talk to you a little bit about himself and his business. And then we're going to jump into Insurance 101 for investors. We'll talk about the declarations page, which is how we consume our policies and the coverage. And then we'll talk a little bit about the insurance landscape post Helene and Milton. So, Ryan, I'll let you take it away to introduce yourself and we can jump into the material.
Yeah, no, I appreciate everything. You guys can all hear me okay still? It's perfect. So yeah, thanks, Mark. I appreciate the introduction. So as Mark said, my name's Ryan Obenreder. My wife and I started the agency about 10 years ago, and I always joke I had to do insurance because my entire, I'll say, in-laws family is all insurance, State Farm, all state independent agents. I had to do something to have like conversations at holiday parties. So we work about 30 different companies. So I always say that we pretty much have an option for every type of risk. So there's no risk too large, too small that we can't really tackle. So again, independent brokerage, work with 30 companies, yeah, just excited to be here. So I know when I was thinking about the group and kind of this presentation, I know primarily there's a lot of flippers, there's a lot of long-term investors and there's builders. So I really wanted to kind of tailor the presentation and talk around what's important to you and what I think you'll find important and just advantageous in your everyday life. So I think the most important thing you guys deal with is funding, and number two should be insurance. You got to get the money to buy the property, and you want to protect that investment. So that's where when I was coming up with kind of different topics, really was want to talk about insurance at a high level. Kind of a 101. Again, dive into what's the insurance landscape going to look like this upcoming year after we had those two major storms, and then again, how to read a declaration page, because at the end of the day, that piece of paper is the most important thing that you have and really speaks to the coverage that you have on your property and protecting your investment. I know at the end I have some Q&A saved, but again, throughout this entire presentation, feel free to interrupt. I want to keep it as interactive as possible. I don't like talking just to myself. So again, any questions, feel free to interrupt. And I'm happy to kind of go, I'll say off script and address those. So you see, when it comes to
before we jump in, Ryan,
yeah.
Before we jump in, can everybody hear Ryan okay? I just want to make sure it may be my computer, but
Yep,
Keely,
I can hear him.
Okay, cool. Just want to make sure. Sorry, Ryan, didn't want to interrupt.
Yeah, no worries. If I cut out too, interrupt, because I won't know if you guys can hear me. So when it comes to insurance, the goal of the policy is to rebuild, repair a property. So let's say you're purchasing a property for $1 million. It's in South Tampa, and it's a 500 square foot bungalow. You're purchasing it for $1 million. You don't need to really get insurance though for the million. What I mean by that is that purchase price, it's going to have the land value and the market value tied into it. So going in with the mindset, the goal is to have a policy that has a limit to really rebuild this structure. If God forbid a fire burns it down, that's the goal of the policy. So I know a lot of investors that we've worked in the past, they'll say, I'm purchasing it for 500. I need a $500,000 insurance policy. And that may or may not be true depending upon like a house. So when it comes to coming up with that figure, we have our agency, we use a replacement cost estimator, which is essentially a piece of software that goes out to the property appraiser's website it pulls in all that raw construction data. So it pulls in if it's a block or frame house, how many bedrooms, bathrooms, is it a metal or is it a shingle roof? All that gets pulled in, and it'll give an estimate of what it would cost to rebuild that structure. I always say it's not an exact science because you can have the same set of building plans. You can go to 3 different builders that are on this call, and each of the builder might give you a different cost per square foot on what they're going to charge to build that structure. But all should be within the same ballpark. Because again, you go to Home Depot, 2x4 might be $1. You go to Lowe's, it might be $1.20. Again, so they're going to be similar in price. So when we come up with that dwelling limit, we always kind of take the middle road. The software gives us a spread, so it may say 200 to 250,000 is the rough estimate to what it would cost to rebuild that structure. We'll do the middle at 225. But you as the policyholder can tell us like, hey, actually, I'm a builder, or you have experience, rehabbing and rebuilding homes. So you kind of know it maybe needs to be bumped up a little bit more because there was something the software missed. So as long as we're within, usually it's a 10% buffer on the higher low end, underwriting's not going to raise any red flags or cause any issues with adjusting that. Same is true if you want to lower it. Again, the lower the dwelling limit is, the lower the price is going to be. So you want to kind of find that sweet spot between, what am I going to insure this for? So if God forbid it burns down, it can be rebuilt, and I'm not coming out of pocket, tens of thousands of dollars to put me back to whole. The other kind of thing to remember when it comes to the dwelling limit is there's something in every insurance policy called a co-insurance penalty. And how that works is, let's say you're buying it for cash. You only want to insure it for $100,000. It's going to cost $200,000 to rebuild it. Again, you just want to cover that $100,000. You're uninsuring your house by 50%. What can happen is let's say a claim occurs where a hurricane blows your roof off, and it's a $20,000 loss. Because you uninsured your house by 50%, they can reduce the claim amount by 50%. So instead of getting $20,000, you would get 10. So that's the other thing to keep in mind is that, again, as long as we're within that range, you're not in jeopardy of having that co-insurance penalty. But again, you don't want to go on the extreme low side just to protect yourself from that clause that's in every policy. So I'll pause there. I know I gave a lot of information, kind of the goal and dwelling limit. Does anyone have any questions right now, or?
Something in mind. So, we're thinking about, of course, either repairing or rebuilding the property. Now, for the kind of policies that investors take out as compared to a policy that a homeowner would take out, not that we're the homeowners, but it's a different type of ownership, right? Is there limits in coverage for us, or maybe types of perils, or the types of damages to the home, maybe wind or fire? What should we think about that maybe we don't think about because we assume that our policies are apples to apples with a homeowner's insurance policy?
Yeah, no, great question. And that actually is a perfect segue into that kind of next bullet there, the difference in policy types, because I think a lot of people, whether they're you get,
Yeah, there we go.
sorry, I keep going back and forth, muted, unmuted. So you guys can hear me now?
Yeah, we can.
Perfect. So yeah, every policy is not the same. Your home insurance is going to be the most comprehensive policy. The insurance jargon is an HO3. That's the most comprehensive policy out there. And not every policy is as robust as that. And that's where I'll say it kind of, especially when you're an investor or flipper, it really boils down to 3 different policy types. The first, which is the most basic policy out there, it's called a DP1. And it essentially only provides coverage for fire, for hurricane, and liability, just those 3 perils. Anything outside of that, there's no coverage for. Think of this as like the catastrophic policy. Again, if it burns down, blows down, someone slips and falls on the property, that's what it's there for. If a pipe bursts and floods the house, there's no coverage for that. If let's say you're cutting a tree down and the tree falls and hits the house, there's no coverage for that. A vehicle, crashes into the house, there's no coverage for that. It's extremely basic, and that policy type is specifically geared more towards the flippers that are on the call. So you're buying a house, it's vacant, it's gonna, take a few months to renovate the property. You're not doing any major structural renovations, such as like building on an addition or like, tearing down structural walls. It's, flooring, cabinets. You're kind of, I'll say, gutting it, bringing it up to I'll say modern standards, and then you're going to be selling it. That's where that DP1 is going to be the policy that you're going to want to go towards. The other policy type is called a DP3. That one is the gold standard for investors that are going to have long-term, it's a long-term hold. You're not just getting in it, flipping it, and moving on. Let's say you're buying the house, you're going to still do maybe some minor renovations, like you're going to replace floors or cabinets, you're going to paint. It might be a 30-day type of project, but after that 30 days, you're going to have a tenant in there. That's the DP3. That's what you want. And when it comes to the tenants, you can have annual or short term. Every insurance company will take the annual. When it comes to short terms, there are a few companies that actually take that short term occupancy. You want to let us or your insurance agent know what the occupancy is going to be to make sure it's a company that allows for that exposure. So there's no kind of, I'll say, surprises where, it's being priced, let's say, by Citizens, which is, they allow annual tenants. They don't allow short term. So their Citizens policy might be $3,000, but the, policy that allows for short term tenants might be, $3,500 or $4,000. So just when you're doing your budgeting costs, you want to make sure that you have the right policy type for the risk exposure. The other policy is called a builder's risk. That one's ground up construction. So again, let's say you buy a property, bulldoze the home, or you just buy a vacant lot and you're going to be building from the ground up. It's called a builder's risk policy. Before going out and purchasing one, I'll say I would talk to whoever is building the property. If you're hiring a contractor, a lot of contractors, you can roll that project under their insurance. So you don't have to actually go out and purchase another policy. It can be rolled in under that contractor's policy. So the contractor will carry the risk until the day of completion. And at that time, you would need to get your own policy, whether it be a DP3 or DP1. I will say too, I know on the DP1 I mentioned it's typically for flippers, you can get a DP1 even if you're doing the long-term hold. Again, you just need to be comfortable with the I'll say the lack of coverage that's on it. DP1s tend to be the most cheapest policies, again, just because of how basic they are, where that DP3 tends to be a little more expensive because it's a little more robust. I'll kind of jump to that next.
So Ryan,
go ahead, Mark.
For a lot of us in the group, our goal is to buy a distressed property, rehab that property. That could be moderate or even, a full gut rehab, pretty extensive renovation. But the goal is to, buy the property, create the value through the renovation, and then perhaps refinance it and keep it, rent it to a tenant. So you think is there a way to be strategic where maybe it makes more sense from a coverage perspective to start off with a DP1 and then 6 months later, when that policy is up or when possible, flip it to a DP3? What do we do in these scenarios when we're trying to renovate the property and then extensive rehab and then keep it for the long haul?
Yeah, great question. And that's where, again, if it's a short, again, 30-day type renovation, you can get a DP3 from the beginning. But if it's more expensive, where it's going to be several months, again, you're essentially gutting it, and then your plan is to rent. You can do a DP1, keep it for a few months, and as soon as the project's done, cancel that policy. The one thing you want to look out for is, which I have a bullet on, is called minimum premium. Again, most DP1s are going to be an annual policy. So for conversation's sake, it's a $1,200 policy. You did the renovations. It only took 2 months. You canceled it, expecting to get the, remaining 10 months with $1,000 refund, but you only got, $900. And you're like, why is that? Well, the policy may have a clause that says the policy has a 25% minimum premium. So what that means is, whether you cancel it in month 1, 2, or 3, the insurance company is always going to hold that first 25% of the premium. Everything after that, they prorate it. So again, if you had it for month 4, 5, 6, they prorate it based on, when you cancel that policy and moved it over. So if you're going to be doing that kind of renovation and then long term, you want to make sure that the policy you have doesn't have that minimum premium clause, or just be comfortable with it. Just understand going into it that, you know what, I'm going to get the 75% of my money back when I cancel this policy. You just don't want to be going with, let's say, a 10 or $12,000 policy, and that number definitely makes a much bigger difference the more expensive it gets. There are some policies they're typically, again, just from a financial standpoint, not to be very feasible. Some DP1s you can convert into an HO3 where it's literally the same policy. It's just they just change the form, so you get extra coverages, and you would pay the difference between the costs. Again, most policies don't have that, I'll say, conversion. There are some that do, but again, just from a pure dollars and cents, typically it doesn't make the most sense to have that conversion policy. Have your DP1 and then get your DP3.
And then one more question. So you mentioned the builder's risk policy. Now, is it safe to assume that's kind of a limited coverage policy because the structure's not built quite yet? But is there ever a scenario where you have to do a builder's risk policy on a pre-existing home, one that we're renovating, it's already built, structure's built, or are those policies purely for ground up construction?
Yeah, so I'd say 9 times out of 10, it's ground up. But let's say you're purchasing a 500 square foot bungalow. You're going to make it 2 stories and you're going to extend it and you're going to make it into a 3,000 square foot home. That you can use a builder's risk for. So it's just those major type of structural renovations where, for every reason you're able to keep that existing structure and just add to it, you can get a builder's risk for that as well. And what's nice is too, and that's where it kind of goes into that, say, middle bullet. I don't know if you can see on my mouse, the replacement cost versus actual cash value, where a builder's risk policy, just by the nature of it, because again, you're not starting day one with a finished house. It's slowly being erected. It's going to be an actual cash value policy. And what that means is that when it comes to a builder's risk, wherever you are in the project, so let's say you always insure it for the completed construction project. So let's say, this is going to be a $500,000 property you're building. You're going to get a $500,000 insurance policy because that's the total cost of the build. Let's say 3 months in, you have the roof on. It's not completely dried in. A hurricane blows it off, and you got to start all over. You're not going to get $500,000 for that. You're going to get, okay, where were you in the project? Maybe you were $75,000 out of pocket. That's what you're going to get. So if you're doing more of that, you're getting the existing structure and building on. So just be aware that, again, you're not going to get the full value of the structure. It's going to be, I'll say prorated based on where you are in that project. Now, the interesting part about that actual cash value is you can apply that same, they call it loss settlement, to both a DP1 and a DP3. Again, it helps keeps costs low because, again, as the owner, you're assuming the vast majority of the risk. But even if it's a fully completed house and it has that actual cash value loss settlement on it, they depreciate it based on the age of the house or the part of the house that was damaged. Most common, because in Florida with hurricanes, is the roof. So let's say that you have a shingle roof, it has a 20-year life expectancy, and the roof is 10 years old. If you have that actual cash value loss settlement, again, it's going to keep your policy inexpensive. But if a hurricane blows the shingles off, you got to redo the roof. It's $20,000. Since you have actual cash value, you wouldn't get $20,000 to replace the roof. They would depreciate it based on the age. So in that example, where there's only 10 years of life remaining, half the life expectancy has been used. Instead of getting 10,000, $20,000, you would get 10,000 because they would depreciate it based on the age of the part that was lost. Go ahead, Mark.
I want to interrupt there because I think this is really, really important for the group. Because I think all of us, when we go into rehabs, we're worried about costs right from the get-go. We think, hey, we're probably going over budget on this. We're already tight on the numbers. It's kind of the nature of the beast. So it's very easy to think about these two policy options and say, man, I'm going to go with this policy that's $1,000 or $2,000 cheaper. But I just want to make sure that we highlight, the potential risk if we choose an actual cash value policy over the replacement cost policy, right? Because, let's say that roof is, to your point, 10 years old and they have a 20-year shelf life. So it's 50% of the way through the shelf life, let's just say, for example. So, if the roof costs 15 grand, well, they're going to depreciate. So they're only giving you 7,500 because that's what the roof is worth. But it still costs you 15 grand to repair the roof, right? So whereas you were being mindful of the pennies up front, you're being, penny wise, you could potentially be pound foolish with the actual cash value policy in the event of, a peril or a disaster because you just may not get the actual value that you need to replace the items that were damaged. Is that right?
Yeah, and that's where and I'm and usually it's not a huge difference. I mean, maybe again $1,500 for the actual cash value, maybe 2,500 or even 3,000 for the full replacement. And especially if you're only holding that policy for a few months because you're just flipping it, you're talking a couple $100, out of pocket. Where if God forbid something happens, you're tens of thousands out of pocket. So, I think the timing goes into that when I'll say that strategy if you're going to use actual cash value. If we're outside of hurricane season, the likelihood of a hurricane happening is zero. So, if you want to roll the dice during that time, that's maybe something to consider. But again, fires are still devastating, and that's with the other peril, especially with that DP1 that you're protecting yourself against. So, definitely look into also the two options and kind of weigh it out. The other thing too, if you have a traditional mortgage, they're going to require the replacement cost. They're going to want that full replacement cost value policy. So making sure you have that if you didn't have traditional, financing, to make sure you're adhering to the lender's guidelines. And yeah, that's sort of, again, the replacement cost policy just doesn't depreciate based on the age of the structure or again, like the roof or any other, I'll say, major system in the house. It's whatever it costs to, to repair that or replace that, minus your deductible. Yeah. So, and I guess any other questions or kind of move on to the next topic?
That's great. Great. Anybody? Any
Awesome.
questions about what we've talked about so far? Go for it, Brian. Let's
Perfect.
get into the inspection. I think we talked about minimum earned premium, unless you want to touch on that again, but if not, we can go to.
Yeah, no, the one thing I'll mention with the minimum premium, just as another just FYI, again, most minimum premium clauses are 25%. There are some that during hurricane season, it'll be 50%. Some even go to 100%. So if you're inside hurricane season, you try to cancel your policy, it may say 25% minimum premium, a little asterisk, and you have to kind of look down and see if there's any sort of provision or clause regarding during hurricane season. So again, just be mindful of that so you don't have any surprises where, again, we're in the summer months, it's hurricane season, you have it for a couple months, but you're only getting 50% back when you thought it was 25. So that's another, again, just additional caveat when it comes to that minimum premium. Yeah, so kind of jumping into the, I'll say, inspection. So there are really two different inspections. This applies to me whether you're a flipper or whether you're going to keep this property for a long period of time. If you're getting a DP1, which again is more common for those flips, no inspections are needed just because of how basic it is. They still want to know when things are updated, primarily the roof, to make sure that the roof isn't 30-year-old shingle and it's leaking, and because they essentially could be on the hook for that. They still want to make sure that everything's been updated, usually in the last 20 years. And again, it's honestly a lot of times just a verbal. You just tell us what age it is. Every once in a while, I have to provide permits to show that on the DP1, but no inspections are needed. If you're getting that DP3, inspections are needed because they know it's more of a long-term hold and it's a more robust policy. So they want to make sure that the 4 points, they call it, which are really the 4 areas of the house that cause the most claims, are in good working order. So it looks at the roof, plumbing, AC, and electrical systems, and it speaks to any hazards that are in that. So that 4 point is a pass-fail inspection. The wind mitigation, again, I would still get one if you're getting a DP1 or a DP3 because it provides discounts. So it looks at 7 different areas on how the house was constructed, and it'll provide discounts based on any wind mitigation or wind preventative measures that were installed on the house. So again, if you're having a policy for a short few months, you might as well save a couple $100, to get that wind mitigation. Long-term plays, definitely get it because year after year you get those discounts. And even when it comes to that 4 point inspection, when you're flipping, Honestly, I feel like that's probably the most important inspection that you can get as a flipper because one, it shows you what you're getting into before you purchase it. And then two, it helps, I think, for the marketability. So when it comes to sell your property, you want to make sure that there are no surprises, and you kind of put that in the seller's mind of like, oh, this is just a lipstick on a pig scenario where they just put paint over it. You want to make sure that what's behind the walls is in good working order. Because again, the person purchasing your house, they're probably going to have a traditional mortgage. They're going to need a traditional like HO3 policy, which underwriting requires these inspections. They nitpick these inspections. So when before you even purchase the property, get that 4-point inspection so you know what you're getting into. And then when you're done with your project, get the inspection again to make sure that you addressed everything and there's going to be no surprises when it comes to comes to market. Also, I would don't have your buddy do it. Get a company that's going to nitpick it because the buyer is going to have an inspector that's going to nitpick the inspection. So you don't want to have someone that's does you a solid. Oh yeah, it's fine. Don't worry about it. And then that buyer has someone come in with their inspector and they're like, hey, this, and this need to be addressed. And you're like, well, my guy said no. And the next thing they're walking away, they're asking for more off, or they're having insurance issues. So again, that's where, again, if you're talking a couple $100, between those two inspections, but to me, it's worth it. Just to make sure there's no surprises. Because, I'll pause there. I'm going to jump into what the actual inspections kind of look like and what to look out for. But
So
any
I want to
questions about that?
reiterate real quick, just from the real estate perspective, like the real estate agent perspective about that, how important that is. Because if the buyer cannot get insurance, if the obviously then they can't get a loan, right? So you're going to have to do those repairs regardless. If the inspection comes back negative and you fail the 4-point and that gets sent over to the lender, you've now opened up a whole nother can of worms. Even if you do make the repairs, it's never a good thing for the lender to feel like the house, has some issues, right? Um, and you also just risk the buyer walking away because the buyer feels already, especially about flips, they're already nervous. They're already worried about that lipstick on a pig situation. And so when they see that these major mechanical items that are going to cause them insurance issues are not taken care of, then they feel like you've probably done some shady work. You haven't really paid attention to the details. So just, yes, this is something that you're going to have to repair, but to Ryan's point, having that inspection, a thorough inspection done, you want your inspector to be more tedious than the inspector that the buyer would even hire because you want your inspector to show you every little thing that could come up so that you can get in front of anything that would scare off your buyer. Because obviously, going back to market is never what you want to do, but you especially don't want to go back to market because the quality of work wasn't good or the house had issues. Because now your realtor has to disclose that when the next agent says, hey, I have a buyer, they're super interested in this house. I'm just curious, why did it come back on the market? And then as an agent, I have to say, well, it failed the 4-point, the wiring was bad. Oh, we fixed it. But now you're at this like uphill battle to try to convince people that the house is good, right? So spending that money on a home inspection, getting those things taken care of, obviously it checks the box for Ryan and his team to easily get the insurance policy through, but it also just does like so much more than that in terms of the deal for you.
Just one more thing to note on that. So I think timing is important. So as soon as our contractor, teams of contractors say, we're done. So we're maybe 90%. This is before staging, before we even start really the marketing process. We're getting the 4-point inspection done. That way, if anything comes up, those teams, they're pretty fresh still in that house. They just got out a week ago, a couple of days ago. And if anything comes up, they're just getting right back in there to finish the job. I really want to do that before I give them their final draw payment, right? So maybe I paid them 70% for a line item and I still owe them 30% after completion. I really want to hold that last check until I have this 4-point and the project is complete. Because if not, things can drag along if you don't have a real solid relationship, especially when you're just starting out and you don't have a track record with the contractor. So super important, 4-point inspection, non-negotiable, especially for the resale. Thank you, Ryan. I know now we're monopolizing the time. We'll give it back to you.
No, no
Take
worries.
us through.
And to me, this is, I think, extremely important because I've seen where I sit, deals fall apart because of 4-point inspections. I've seen investors get honestly screwed because of 4-point inspections. Where they anticipated replacing floors and cabinets, and turns out there was polybutylene piping in the house, and now they had to replumb the entire house to actually sell it, and that blew their budget out of the water. So I've unfortunately seen that. So no, I think it's extremely important. And even though it's not required from an insurance perspective, or even like, again, you're purchasing it for cash, good practices to have. And that's kind of where, what I'll do is I'm going to jump into, let me do it this way. I'm going to jump into a 4-point inspection and kind of how to read this form. So you guys able to see this okay? So this is what I took out a lot of contact information, but this is a standard 4-point inspection form. This is the one that Citizens, I'll say, uses, or they don't require. You can use other ones, but most of the 4 points that you come in contact with are going to look like this. And again, it talks to the 4 points in the 4 areas, which is the electrical system, the HVAC system, plumbing, and the roof. And when you're looking at it, I don't want to go too much into detail. Talk about the main panel, the amperage. These 2 boxes here are going to be the most important for you. If anything is checked here or anything is checked here, you're going to want to address it. Again, up here, it talks about cloth wiring, if there's not a tube, aluminum wiring. These wiring types are hazardous, and the vast majority of companies do not accept them. There's some caveats to it, but again, if you're looking at, especially for flips, you're going to want to have the biggest marketability that you can, where everyone from State Farm is going to want it to Citizens, and everywhere in between. You don't want to have it where the buyers be pigeonholed to one company that's obscure company because there's cloth wiring present.
And I would imagine if they end up getting
here,
pigeonholed to one company, it would probably be a much more expensive policy, right?
Typically, yes, it is.
Yeah.
Yep. Where there's a lot of people, there's no competition, so there's no competition, rates tend to be higher.
Right, which will deter them from even moving forward, on top of probably understanding the safety concern that they're going to be living in a house with those issues.
Yeah, and of course, electrical fire. I mean, that's the first thing that comes to someone's mind, and I don't want my house burning down because of electrical fire. And that's where even here, like this inspector noted that the electrical system was satisfactory. So you don't want to just see that and be like, oh, it's fine. There's hazards. There's double tap breakers or double tapped breakers. There's empty sockets. Even though these are minor issues that typically aren't big deals, there's still issues. And underwriting from an insurance perspective does not look at it as like a little thing. They want it to be addressed. And even Citizens, when it comes to electrical issues, they want it addressed before they issue a policy, before closing. So don't say like, oh, I'll just give them a $1,000 credit to fix it. Get it done before. The other thing to look out for is the brand of the electrical panel. Federal Pacific and Zinsco are the 2 most common hazardous brands. They were recalled years ago. Homes that were built in the 70s, 80s, typically you'll see have that panels. Just be aware of that, where again, Federal Pacific and Zinsco, Slovenia are the most common ones that are hazardous that you'd want to replace. The HVAC system, again, this one's a little more easier. It's a central, yes or no. So central AC or the wall units. Is it in good working order? Yes. Any hazards? No. So the only thing here when it comes to the age of the systems, as a general rule, most underwriting wants everything as far as the AC and the water heater to be 20 years or newer. Water heater, a lot of companies have shifted to 15 years. You want to just be mindful of that, where if you see an HVAC system that's, again, 19 years old, 21, 22 years old, maybe look at replacing it. Again, just makes it easier for that buyer to get insurance. Same with the plumbing section. It's, again, pretty, I'll say, easy, where, is there a pressure release valve? You want to see yes. Any sort of leaks or prior leaks, you want to see no. The age of the system you want to pay attention to. Because, again, 15 years and newer, every company wants. There's a few that'll take it from 15 to 20. There's only 1 or 2 that I know that'll go over 20 years. It's in a garage. But again, you want to look out for the age of the water heater. just something to budget for if you need to replace it. And again, are there any hazards? So, any unsatisfactory plumbing. So here the sinks, you can see that there's some leaks going on. Excuse me, in plumbing area that we'll want to address. A little bit lower, it talks about the plumbing types. Polybutylene and PEX, these are the ones you really want to look out for. Polybutylene, no one takes it unless they completely exclude water. So whoever's buying the house would have to go with 100% water exclusion, which odds are they don't want. So polybutylene is the one that typically 80s, 90s homes will have polybutylene. PEX, new homes use PEX, so it's a little confusing, but I believe it's 2005 and older PEX. They were recalled because of how like the joint between the two pipes, there was some failures which caused leaks. So if you see, again, a home built 90s, early 2000s that have PEX plumbing, you can talk to your inspector and they can tell you whether or not it's the hazardous one. But PEX is one of those that newer homes have it and it's fine. It's just that older PEX that you want to look out for. So you're not buying a house that has it and you turn around having to replumb a house that you didn't expect. Roof, this is probably the most important when it comes to insurance. Underwriting is extremely picky when it comes to roof ages and life expectancy. So you can see here, it's a modified Benjamin roof. Most companies want roofs to be at least 15 years old or newer. Citizens can go up to 20 years. But again, most companies in general will want 15 years or newer with 5 years of life remaining. So like this one, it's 12 years. The inspector said it was 3 years of life remaining. That right there is going to cause issues for anyone you're trying to sell the house to even get a traditional insurance policy for. You can kind of see down here again, the overall condition satisfactory. They noted there was some ponding. There's no leaks here. But again, the age of that roof is going to cause issues. There's architectural shingles as well on this roof, 4 years old, 16 years of life. Everything looks good with the shingle part. It's just the flat roof that's going to cause issues. And when you go down and actually look at the photos, you can see it's a mansard roof, so that's why there's the flat and the shingles. And then when you get to the photos, you can see the flat roof. So like here, this flat roof looks good. This isn't probably the one that inspector, I'll say, dinged, that would want to be replaced. So I'll pause there. I know I kind of gave a lot.
I want to give a few quick thoughts about for the flippers or, for anybody really, but so about how the 4-point kind of applies from the very beginning of the process, right? So when you're purchasing a house, you're thinking about these major mechanicals and these 4-point, items on top of all of the pretty cosmetics. You need to be thinking about these things, I guess is what I'm trying to say, because a lot of flippers will think that they're going to go in and they're just going to kind of update cosmetically. And then when they go to resell the house, they run into all of these issues. Now, in a market a couple years ago where things are rapidly appreciating and people are very loose, they don't really care about the condition of the property, they'll stick it out, they'll let these things get repaired. That might hurt the investor financially. That's a different topic. But, in today's market where buyers are scared, they're picky, they're really wanting to get what they feel is a good value for their money because interest rates are so high, so their payments are high. All of these things need to be buttoned up. So just thinking about when you're going under contract on a property, what are some things that you can do aside from paying for a home inspection? Because of course you could do that, but most investors are not going to hire a home inspector to come out and pay $500 for a home inspection on a property that they're not sure they're going to purchase. But as an investor, I can do my own due diligence and kind of use educated guesses to predict what things I'm going to have to replace to satisfy this 4-point and what things are already done, right? So when I'm doing the walkthrough, one of the things I am going to look for is if I can see the brand name of the electrical panel, because if I see one of those older brands, one of those brands that have been recalled and are considered unsafe, I automatically know right there I'm going to have an additional $1,500 to $2,000 in expense to replace the electrical panel. If I'm purchasing an old house, and this kind of goes back to what I constantly preach about understanding what you're purchasing, If I'm purchasing an old bungalow in the Heights, I'm just automatically going to assume that it probably has knob and tube wiring or cloth wiring and needs a full rewire. I'm going to assume that it probably has galvanized pipe, some sort, it probably had a repipe at some point, but there's going to be some galvanized under there that could cause an issue. Another thing that I would ask about is, especially if I'm purchasing it from a seller like on MLS, I want to see their seller's disclosure to see if they're disclosing any of those other pipe issues, right? If they're aware of any of those things. Another big one is checking permitting. If they're claiming that the house has a new or newer roof, you really want to check permitting to make sure that that's a permitted roof. Because one of the things I often see on the real estate side where we run into insurance issues is the roof is only 5 years old. And the home inspector can get up there and he can see that the roof is in good condition, but he can't confirm the install date of the roof, via permitting, right? And so he can't really put down that the roof is 5 years old. And so we run into this like gray area that tends to cause problems for insurance. So you want to check permitting yourself and make sure that anything that's being listed as being new of these 5-point issue, or I'm sorry, 4-point things, that those were permitted, right? So that you're going to get credit for them on the 4-point, because just because the roof is 3 years old doesn't necessarily mean that that's how it's going to be conveyed on these documents, which are the documents that the lender is going to use to approve the loan and the insurance company is going to use to insure the property. So these are all, just kind of things that you can do up front, due diligence wise, to make sure that you're not, buying a house that you think has a new roof and then having to replace the roof or jump through a whole bunch of hoops or not be able to sell your property because it can't get insurance, right? So, just some things to think about up front where you can, again, kind of use your own education to predict what you're going to have to spend money on to keep this 4-point clean and good and the property insurable.
And when it comes also to that roof, you have a good point where a lot of, people, roofer didn't, I think it was 2005, 2006, typically after major hurricanes, the county or the state will list permits so that you can replace your roof and get things done a lot quicker. So after the 05, 06 storm season, where we had like Charlie and we had several named storms, permits were lifted for roofs. So a lot of roofs were put on without permits, but there was documentation that was done. They paid a roofer, so there has to be some sort of documentation. So if the seller has documentation regarding when the roof was replaced, we can use that to show underwriting, like, hey, I know it wasn't permitted, but here's the work order that was done to prove that this roof was replaced in this year. And a lot of the times underwriting will go by that. So again, if you're buying a house that doesn't have a roof permit, see if the sellers have some documentation before you close, so that you don't close and then, the seller's done, you're never gonna be able to talk to them again. At least you can get that documentation that you can provide to an inspector or provide to the insurance agent that they can use. And that's kind of, I'll jump now and kind of in that wind mitigation, which wind mitigation primarily looks at the roof and how it was constructed, and it's all about discounts. Again, for those of you that have that long-term kind of plan where you're going to be having a tenant in there, you're going to hold this property for several years, you want to make sure you have this inspection, because again, it provides the most discounts on an insurance policy, and you get it year after year after year. As I mentioned earlier, there's 7 discounts that are provided on the wind mitigation. A lot of people think it's one discount. I got the wind mitigation, I get a discount. It's not. You have 7 sections, and each section comes with a different level of discounts, all encompassed in this one report. The first probably doesn't apply to anyone unless you're dealing in Miami and Dade counties. It's this building code section, again, only applies to Miami-Dade. Number 2 is kind of where everything starts for most people, and it speaks to the roof covering. So if the shingles are hurricane rated, or they meet current Florida building code, that's what FBC stands for. So again, any any roof replaced after 2002 that was permitted automatically will get this discount for the shingles meeting Florida building code. The next is so if you picture a house, you have the shingles. Shingles have to sit on something. So it's the roof deck. How thick's that plywood, and what type of nails are used to hold that plywood down. There are, again, primarily 3 different levels. She is the best. Well, reinforced concrete is the best, but again, the residential house doesn't have that. You'll want, again, thicker plywood, and you'll want to have a longer nail, which is an 18 nail. The next section is, okay, you have the shingles, you have the roof deck, you have trusses that are sitting on the house. How are those shingles connected, or how is the rafters, like how are they connected? And there's several different ways. The most common is either nailed, there's hurricane clips or hurricane wraps. One thing that I see often, and this house doesn't have it, but one thing I'll see often that you want to look out for is you see toenails checked, and then you see this box right here checked, that they're saying there are metal connectors there. They just don't meet the conditions or requirements to get either B, C, or D. So clips or single wraps. And typically what it is, it's a missing nail. In 2002, building codes changed that stated that if you have a hurricane clip or hurricane wrap, it has to have a minimum of 3 nails. You can see here the requirements. Prior to 2002, they didn't require 3 nails. So you could have 2 nails or even 1 nail in that metal connector and check the box for code. The wind mitigation is based on 2002 building code, so it has to meet that building code. What I see commonly is that there's straps there or there's clips, and there's only 2 nails, so you need 1 extra nail. So if you're, again, going to be replacing the roof, you can easily then have your roofer or contractor add that extra nail. Even if you're not replacing it, there are companies out there, they're called third nail services. They'll either go up in your attic, or more times than not, they'll go into the soffits and they'll put 1 extra nail in each one of those trusses. So you get the discount. And this is the biggest discount that the wind mitigation provides. I've seen policies go literally from $10,000 down to $4,000 because of this. It was an older frame house in Pinellas County, which is more subject to wind versus Hillsborough. And there's a huge, huge, huge savings. So again, on long-term holds, if you don't recoup that investment year 1, typically you do in year 2, because if you hire a third nail service to do it, or again, you can do it yourself technically to put that extra nail in. But if you hire a company, it's usually right around $1,500 to do that. And again, if you don't get that year 1, definitely by year 2, you'll recoup that investment. And even for the flippers, if you're going to be replacing the roof anyways, something to look into just to, again, make your house more attractive to that buyer, where insurance rates are going to be low. Again, just reduces that risk of having a DTI issue, and overall just happy buyer that their insurance rates are as low as possible. And again, if you're replacing that roof as a flipper, best time to do it. It's extremely easy for a roofer to add that 1 extra nail in to get that discount.
So Ryan, just to be clear, so for the most part, all of us are ordering the roof as a part of the rehab because buyers are expecting that, right? So what are we asking the roofing company for, right? How do we position it with them before they do the install? Are we saying, hey, we need this roof to wall attachment? Is it a third nail? What is kind of like the industry jargon for what we're asking for so we can get this discount?
Yeah, great question. I would say third nail. Most roofers know what that is, that you need a third nail installed in the hurricane strap. I'll use strap and clip interchangeably. They're essentially the same thing. It's just one wraps over the truss, the other one just sticks up next to it. So I'll say strap and clip, and it's the same thing. They all have to have 3 nails. So yeah, you would just say I need a third nail in the hurricane clip, and they should know what it is. What most roofers will do is, again, they're ripping off the roof. They're literally taking a saw and they're cutting along the entire side of the roof where the trusses are, 1 to 2 foot section of the plywood, lifting it off, popping in that nail, putting down the plywood, popping it right back on. So it's an extremely quick process for that roofer to do. Again, they're going to charge for it, depending on the roofer. But again, especially if you're replacing the roof, I've seen it as low as $500 for a roofer to do that, just because it's so quick and easy for them to do that work. And again, the discount, it's usually in the several hundreds, if not thousands. It's a percentage of the policy. So if you have a $1,000 policy, it's going to be a lot lower. But the more expensive the policy is, the older the house is, again, a frame house, it's just going to reduce that premium even more. The next is the roof shape. Not going to change that probably. It's either going to have a hip or a gable roof. Gables, 2 bookends together. Hip looks more like a pyramid, So if you're staring at the roof, you're seeing shingles versus the gable ends. If you added like a peel and stick or secondary water resistant barrier roof, and the last one is opening protection, which is hurricane shutters. So if all openings, windows, doors, garage doors, any opening on the house, skylights, has to be protected by an impact rated material. So whether the window itself is hurricane rated or you have a shutter, that's what that discount speaks to. So that's really and again, these are the pictures that kind of justify. And I'll show you you can see here, this is the hurricane clip. And I don't know if I can probably zoom in, you can see the 3 nails, 1, 2, 3, and that's what the inspector looks for. So again, if your inspector only sees 2 nails in there, that's where, again, especially if it's a long-term hold, I would say go and do it if you're going to replace roof. Even if it's a flip, it again, just adds to that, I'll say, marketability. And it's, again, very easy to get to. Any other questions about the inspections?
I have one, Ryan.
Yeah.
For underwriting purposes of the 7 categories for the wind mitigation, which category gives you the most discount?
Yeah, so it would be the hurricane clip. So it's the I'll show you this section. The roof to wall attachment. This right here provides the biggest discount on the home insurance. This up here, this one's usually $50, maybe $100. This one here, again, maybe $100 to $200. This one here, I've seen in the thousands. And again, it's just, as you can imagine, the roof is the weakest part of the house when it comes to hurricanes. So shingles blow off, that's one thing. A roof blow off is a much bigger issue for the insurance companies because they're not only replacing the roof, now there's interior water damage. Their homeowner can't live in the house, so they're paying for that additional living expense or that displacement. So that claim quickly escalates. So again, if you have the trusses held down by that metal connector, I don't know the research, but I know it's extremely, I'll say, better to withstand that wind damage and actually rip the roof off. So this is the biggest discount is right here. It's number 4. And again, clips and single wraps. Single wraps are better, but again, you're talking maybe a $500 discount for clips, $550 for single wraps. They're very similar. Some companies don't even differentiate between the difference in pricing. So again, this is what you'll want to see. Great question.
Gotcha. Okay, awesome. Yeah, the reason why I ask is I do these inspections at 4 points in wind mitigation, so I just want to be educated. So when I tell my clients, what's the biggest discount, I'm telling them accurate information. So that was helpful.
Yeah, and that's where again, if you Google third nail companies, there's 2. I think one is like thirdnail.com, the other is thirdnail.net. We have no affiliation with them, but those are the ones that we'll recommend to clients that work in the Tampa area. I forget which company actually has like their pricing on their website. But again, if you just Google Third Nail Service, Tampa Bay, you'll be able to find those companies and you can recommend that. So again, if you're doing it, an inspection, and again, you see that it only has 2 nails, you can recommend that company to come out and do that for that homeowner to get the discount. And again, it usually is not year 1, year 2, they recoup their investment.
Yeah, I actually have 2 buddies that has a company like that. I send them referrals.
Oh, perfect.
Yeah.
Yeah, and it's nice because a lot of times you just go right into the soffits. It's have to crawl through the attic and deal with all that, especially in the summer. Any other questions before I jump to the next? Perfect.
Great.
So I know we just went through, especially the Tampa Bay area. I'm assuming everyone's in the Tampa Bay area. The worst storm season that we've seen in over 100 years. It was awful. It was some of the worst that I've ever seen. Again, my whole family is in insurance, worst they've ever seen. We had over 18 named storms. We had 11 hurricanes. We had 5 major hurricanes, which are Cat 3 or higher. Right now, the rough estimates for just the hurricane portion, not including FEMA, was over $6 billion worth of claims. And again, that number is still rising as claims continue to go in and things continue to get settled. So I know a lot of people are nervous about 2025. Are we able to get insurance? Are people leaving the market? If I'm buying a house, trying to sell it, like what's that going to look like? The good news is that it actually isn't that bad. And I'll kind of go into reasons why, but these are, I'll say, real numbers based on the state, the Office of Insurance Regulations. So 15 companies actually submitted for a rate decrease next year. 29 companies actually filed for no rate change. They're keeping their rates exactly where they are. The average rate increase, if you have to look at the entire insurance industry, is right around 1.5%. So practically nothing, especially given these last couple of years where we saw, double-digit rate increases. There's actually 9 new companies expected to come into the market next year. So why? We just had all these crazy storms. Why is the insurance industry not going as crazy as we thought it was going to be? A lot of it has to do with a roofing fraud issue that was, I'll say, thankfully plugged due to legislation. Because when an insurance company is paying claims, it's really out of, I'll say, 2 buckets. One is their savings, the other is their insurance. So the nice thing about hurricane claims is that it falls under reinsurance. So every insurance company has what's called reinsurance, which essentially is an insurance policy over their book of business. You can structure it a bunch of different ways, but for conversation's sake, let's say a company like Progressive, if every home that Progressive insures was to be destroyed by a Hurricane Andrew, they would be on the hook for $1 billion. They might take out an insurance policy for $1 billion and have a $10 million deductible. So that's all Progressive has to pay for a hurricane is $10 million. Everything after that, their reinsurance kicks in. So a lot of these claims that are being filed, it's all being paid by reinsurance. So essentially the insurance company has prepaid for hurricane claims. The claims that are non-hurricane related, these are like the everyday claims like fire, a normal storm that happens, lightning. These are paid from the insurance company's surpluses, so their savings. And that's why a few years ago with this roofing fraud issue, so many companies went bankrupt because the claims weren't hitting the reinsurance, they were hitting the everyday funds. And since insurance in Florida is such a heavy regulated industry, because at the end of the day, if an insurance company goes bankrupt, the state of Florida will step in to pay claims. The state of Florida is extremely concerned with insurance companies and profitability. So I believe it's 5% is all the insurance company can bake into their profit margins. So every quarter, the state is analyzing the insurance company's financials and making sure they're staying within that 5%. You can imagine that if companies are experiencing record losses because of this roofing fraud issue, the state is going to say, you got to stay at least 5%, so you need to increase your rates by 30% or 40%. Thankfully, again, that kind of, I'll say, loophole that a lot of roofers were using was plugged. So we just had kind of I'll say a normal hurricane season. Insurance companies expect hurricanes to happen. They have that reinsurance in place, and you can see kind of the proofs in the pudding where 2025 actually looks to be a good insurance market. I know a lot of the claims that happen, especially with Helene, were flood related. The nice thing about FEMA claims is that because it's regulated by the government, it has rate caps. So the most a FEMA policy can increase is 18%. So you may see some larger increases on the flood insurance side, but the home insurance side should stay pretty flat, I'll say. A quick side note when it comes to flood insurance, and this is again whether you're a flipper or you're going to have that long-term hold. So even though FEMA has that 18% rate increase, like cap, I think it was 3 or 4 years ago, FEMA changed the way they rated flood insurance risks. The goal of it was to bring flood insurance down for the country, which it did. The problem in Florida is it raised it up because they now take like distance to the coast into consideration. So what FEMA did though is say, okay, any existing policyholder will be grandfathered in under the old rates. So what can happen is the current owner of that house is paying $2,000 for flood insurance. You're a cash buyer. You don't care about the flood insurance. It's outside of hurricane season. You in your head are, okay, the current owner is paying $2,000, 18% rate increase. So you're, 2,600, whatever the math is. You buy the house, you flip it, buyer tries to come in and buy it, and flood insurance is $6,000. And like, well, Ryan says only 10%. The problem is that original policy was grandfathered under the old rates, and now a brand new policy is subject to whatever the new rates are. The nice thing though is, and this is where it's important for both flippers and for long-term investors, FEMA allows you, a seller, to transfer their policy to a buyer, and you're able to maintain those grandfathered rates. So again, even if you're flipping that property, it's a good idea to look at what is the current homeowner paying and assume that policy, even if you're going to keep it only for a few months, because you can transfer that policy to anyone that's buying the property. And again, if you're buying let's say a house, you're flipping it, it's going to be in that $200,000 to $300,000 price bracket. A $2,000 flood policy might not be a big deal, but a $6,000 or $7,000 flood policy can cause so many people to walk away, DTI issues. So again, assuming that seller's flood policy is going to be just another feather in your hat to keep your property the most marketable possible. And the nice thing is FEMA makes it so easy. It's literally a form. So you can only do it through the existing agent. But there's a form that FEMA has that the seller sign and the buyer sign, and that agent submits that form to FEMA, and FEMA literally just changes the name on the policy. The terms stay the same, the limits stay the same. It's literally just updating the name and contact information, and if there's a lender, and that policy just continues. So it's extremely easy, and it's worth the extra 5 minutes of work.
So I think this is absolute gold for everybody because we're always thinking about marketability, selling it, the resale, right? Selling it on the back end. So what you're saying is, like, whenever we're acquiring a property as an investor, as a flipper, we need to track down the existing flood policy if there's one in effect, and we need to assume that policy and just look at that as an investment in securing or at least opening up the market to as many buyers as possible on the resale, right? So I get that policy, I secure it at 2,000 so that that next buyer coming in, if it's a flood zone especially, but if not, in general, I think people are probably a little more apprehensive or just more aware of potential flood damage after the most recent storms. But securing that lower policy amount will help us with the marketability on the back end. So it's an investment that we're making, and we need to try to do that almost every single time we're looking into a property to see if there's an existing flood policy.
Yeah, and again, it's so easy. What's nice is too, and again, you can work it out however you want with the seller, but technically nothing is owed because every FEMA policy has to be paid in full each year to renew. So again, let's say it's $2,000 and it renewed 6 months ago. That policy's been paid in full. FEMA isn't canceling that policy and writing it. They're essentially just changing the contact information on it and continuing it. So if it was a February 1st, 2024 renewal and it renews February 1st of 2025, the policy term remains exactly the same. It's already been paid in full. So as a flipper, you're not having to spend an extra $2,000 for that policy. You keep it. Now, again, I'm assuming that the realtor of the representing the seller is probably going to put in the contract, okay, you owe my client X amount of money to keep that policy. But again, you're only looking at a couple $100 to continue it. And then the same is true when you go to transfer it. You can work it into the contract, but essentially the person buying it doesn't have to actually pay for that in full. They're just continuing it, and at renewal, they see the full price kick in.
So that's a great point. So you're actually, whatever that annual amount is, you're not necessarily even purchasing flood insurance for that annual amount. You're purchasing it for your holding period, which is, for most of us is 6 months, right? In these books, maybe longer, but for the most part, a half a year. So whatever the annual policy amount is, right? It's really just half of that is what's going to be your investment to secure that lower policy amount or premium amount for the future buyer. And I think it's just nice to be able to market the property that way. Hey, we've secured a grandfather rate on the flood insurance so that this doesn't impact potential buyers. That's something you can have your realtor communicate. As we're getting potential buyers come to the home or other agents are bringing buyers to the home. It's just a really easy way, I think, to open up the marketability of the house and just show that you're going that extra mile. Those little things do make the difference with buyers.
Awesome. and I just saw the time. I didn't realize we're over the hour. But I'm going to jump into I know everyone's still good on timing, I'm assuming. We're all rocking and rolling. Awesome. So the last thing that I want to really touch on is the declaration page. Because again, you get the insurance policy, it's a piece of paper. And that piece of paper is extremely important. You want to know what you have, what you're actually purchasing, because when you have to use that piece of paper, that's when the policy actually matters. So let me get back into here. So this is specific. This is a Tower Hill declaration page. Tower Hill, I will say, is extremely competitive for DP1s. So if you are a flipper, again, Tower Hill is just extremely competitive, has a really good policy for a DP1, and tends to be pretty inexpensive in the grand scheme of things. So every policy will look a little bit different than as far as like the setup, I'll say, of it. But all the information that you're going to see on this policy is going to be on every other policy out there. So the top part, again, I took out the contact information. You can see the policy period here. And then here you see the coverages. This is the dwelling, which that is the one that relates to if my house burns down, what are they going to give to rebuild it? You can see here $364,000. Other structures that being detached from the house, this just it says included, which I believe it's 10%. So again, 364, it's 10% of the dwelling. So you have $34,600 worth of other structure coverage. Some companies doesn't include it, so you can see 0 there. You can add coverage for other structures. So let's say it was a detached garage or a detached house or something like that. You can add that coverage in. So think of the house itself. You could picture the land, and then you're putting, your kid building. I have a 6 and 4-year-old, so they're always building Legos. You're building those little Lego houses on that property. The main house is a dwelling, any detached structures. So again, a fence, a shed, a home, garage, that is a separate coverage on the policy. So if you have another structure, you want to make sure that if you care about the coverage, that the limit is there to rebuild it if it does like burn down. Personal property, again, this was a flipper property. There's nothing in the house. They don't care about the personal property. If you're an investor and let's say you're supplying the dishwasher, the fridge, the appliances, you could have $5,000 to $10,000 here if you want it. For a rental value, this policy just comes with it. Again, if you're a long-term investor, this is important because what it does is, again, let's say a hurricane blows the roof off, your tenant has to move out, and you lost rental income for several months. This will reimburse you for that lost income. Liability, someone slips and falls on the property. And medical payments, I wish it was named something different, but it's not like medical, like, oh, I got sick and I have medical payments. It's actually for others. So the best way I've heard it described is like the police don't sue me money. So someone comes on your property, they trip over a hose you left out, they twist their ankle, they go to a walk-in clinic, they have $1,500 worth of x-ray bills. I'm not suing you, but they have $1,500 worth of bills. You can actually pay that through the medical payments on your insurance policy. So again, it's just that little layer before it gets to the actual liability where there's a lawsuit, minor medical issues that are injuries that happened on your property. When you come down here, so a lot of people just look at this and they're like, okay, I know what that is. This, I would say, arguably is almost more important because these limits are great. Here's where it kind of talks about those limits. And this is where that replacement cost versus actual cash value will live. And you can see here, it says replacement cost loss settlement is included. So this policy not only provides $364,000, but it's replacement. So if it burns down, that's what you're going to get. They won't depreciate it based on the age. So that is really important. Again, you can add other endorsements into here. Like, again, if it's a rental property, very common things that you'll see because that DP3 allows for water coverage. Sometimes policies will exclude it. Sometimes policies will only provide a $10,000 limit for water. So pipe burst, the most they're going to pay out is $10,000. Some do full water. All that information is going to live here in the additional endorsements or in the additional information that's going to be below the coverage section. So these, again, important to kind of familiar yourself with. And you can, ask your agent, like, hey, what is this? What does this actually mean? Or what is this surcharge? What does this actually mean in normal terms? And I'm happy to walk through it. Again, the price, deductibles, this is another really important section. Your hurricane deductible is always going to be a percentage of the dwelling, which again, I don't know why they don't just call it dwelling, they call it coverage A because it's A, B, C, D, so on. So whatever the dwelling limit is, a little bit of math problem, it's 2% of that. So it equates to a $6,900 hurricane deductible. And then anything non-hurricane related is this all the perils deductible. In this case, it's $2,500. One thing, if you're an investor, that's going to just be flipping a home, and you're doing, let's say you're purchasing that property now. The odds are it's going to be finished before hurricane season. You may want to take a little bit higher of a hurricane deductible. Again, that's going to keep premium low. But again, the odds of something happening during this time is practically zero when it comes to hurricanes. So having a higher hurricane deductible outside hurricane season might not be a bad idea. The other thing is this Tower Hill does hurricane, all the perils. Some companies do wind as a 2%. The wind could be a hurricane, it could be a tropical storm, it could be a tornado, it could be a normal storm, like one just blew through here, the cold front. Let's say that had some wind and it caused some damage. That can all fall under a 2% deductible versus, in this case, it's a hurricane. So it has to be Hurricane, Milton, Hurricane Helene, Hurricane Andrew. It can't just be a tropical storm. That would fall under the all in the perils. Down here, again, this is, oh, go ahead. Yep.
Regarding the hurricane thing, because I've been getting a lot of different answers from this, like even from lawyers. So when it comes to protecting the home, like say it got flooded, right? But you have to take out the drywall, you have to like do things in order to save the value of the home. Even if you didn't have flood insurance, should the hurricane policy be covering at least the preventative measures that you did, like taking out the drywall, preventing the mold, drying up the unit? Would that fall under, hurricane, or is that still considered flood? Like I said, it's, trying to protect the value of the home, something that you have to do anyways.
Yeah, no, great question. And that's probably the most question I get when it comes to hurricane, because a hurricane can cause wind, a hurricane can cause flood. So if a hurricane causes the damage, where does it fall? And every insurance policy, every standard insurance policy has an exclusion for flood. And you can probably, if it's not up here, it's here it is right here. Probably does not provide flood coverage. So in the actual policy, they'll define it. But theoretically, even if it's a hurricane, if any sort of water that starts outside rises up and comes into your house, that is excluded under every standard insurance policy. So again, even if it's hurricane related, there's no coverage for that rising water. Now, if a hurricane blew the roof off and water came in, or a tree fell, and again, it caused an opening, and that water came through that opening, and it flooded the house, then it could fall under the home insurance policy. So again, I think your house had really no, I'll say exterior damage that caused an opening that allowed water to come into it, and it was just that rising water. There wouldn't be any coverage for the rising water on that policy. And that's what they define as a flood, is that, again, that rising water. So yeah, definitely, it's tricky because the hurricane caused it. But again, if it rose up, there's no coverage under a standard home insurance policy for that event, even if you're having to replace the structural components of the house.
Okay, so it's not really, it doesn't make a difference whether or not you're trying to like protect the value of the home, or like something that you actually have to do. It more so, it's important how it happened, like how the damage got there.
Yeah, what underwriting claims always talk about what triggered the loss. So
right. Okay.
You have all these other things that happened, but it has to, I'll say, pierce the claim coverage threshold. So if there's a flood, even if it was drywall and all these other things that happened, the initial trigger, initial cause isn't covered. So therefore, everything underneath that is not covered. If again, a hurricane blew the roof off and all this stuff happened, hurricane damage that caused the roof to blow off is covered. Therefore, these ancillary things that happened afterwards can be covered.
Right. Gotcha.
Yeah, great question. Because I get that literally I get it all the time. About like, where's that kind of line go? And that's where I always say, starts outside and rises up. It's not covered under the home policy, and you'd have to get that flood to cover it. And that's where, again, the devil's in the details. Every insurance policy will have something like this in it regarding flood insurance. And again, this one talks about like animal sinkholes. It's premises liability, meaning it has to happen on the property versus, off the property. Home insurance, like if you have a standard home insurance policy, if you're in Publix with a shopping cart, you bump someone, hurt them, your home insurance policy could actually pay for that liability, even though you're off the premises. So again, this is just a premises liability. Up here, you'll see the policy form is that DP1. So again, very basic. Again, think fire, wind, and liability. Just those three coverages. And you can see here, year of the roof. It's the vacant property. It's a renovation. It's not going to be like an annual tenant or a tenant occupancy. And construction type and so on and so forth. So that's kind of the basics of it. The first part is going to be the actual coverages. Here's kind of a little bit more of the breakdown of like what actually goes into these numbers. There's going to be replacement costs or actual cash value, the deductibles, and then what kind of policy form it is. And again, just some basic home characteristics about the house. So that's kind of the, I'll say, deck page in a nutshell. Any other questions about that?
Mine's not about the deck page specifically, but more so just a general question about kind of as investors covering ourselves. So I know that sometimes the policy, like once we sell the property, we get like a prorated amount of like what we didn't use. We get that like refunded to us. Is it, in your opinion, is it a good practice because you're going to get refunded for the portion that you don't use, assuming that you're kind of going to get out of the property in, 60, 90, 120 days, like increase the insurance? I'm specifically thinking more so about things like medical bills or liability stuff, like increasing the insurance or kind of doing the best possible coverage that you can, because it's only a short time horizon, right? So you're not really paying the full, whatever, $4,000 for the policy. If you get out in 90 days, you're paying a third of that. Is that kind of like accurate in terms of how the proration works? And like, what are your thoughts on kind of where investors are underinsured? Like, where would you feel an investor is underinsured? Is it with the building? Is it with liability? Like, what can we do to kind of make sure that we're not just getting the bare minimum, and if something happens, the policy was a waste of money?
Yeah, and I would say it would be those two. So the dwelling limit is extremely important. The liability is also extremely important because again, you want to make sure that the liability limit, it's enough to satisfy any attorney, because the attorney's going to go after the insurance first before they go after you. So again, if you have $1 million, someone dies on the property, God forbid, 300, that's typically 300,000 is the highest that's offered. You may need what's called like an umbrella, which would just extend that liability to add a little bit more. But I would say the dwelling, the liability, and the deductibles, those three things are probably the most important. So again, the deductibles are just going to go out of pocket. So again, you have a crazy high $25,000 deductible. You got an $800 insurance policy, great. I save a lot of money. The problem is the vast majority of claims are going to fall way under that deductible, and you're not going to use it. So making sure that the deductible is within a limit that you're comfortable with. So if you do have to use it, it's actually worth it. And then again, the dwelling limit and then the liability. I would say those three are the most important when it comes to an investor. Any other questions about the?
Ryan, if you can bring us back to your contact information on the PowerPoint slide, we'll just do Q&A real quick because we're keeping you way past the promised time. And this has been fantastic. So thanks for giving us the extra time.
Yeah, no, I'm happy to help. Like I said, I've enjoyed I didn't even tell I enjoy insurance.
I have a quick question for the general Q&A to circle back on another topic.
Yeah.
So thinking about hurricane coverage, post Helene and Milton, post storms, right? As investors, we're already getting contacted by homeowners that suffered flood damage and are now looking to get rid of their properties because they're not going to repair them, right? So they want to sell their house to an investor for cash. They're reaching out to flippers. In terms of insurability of the property once we renovate it and we go to resell it, right? Because obviously I feel like we can get insurance for the property the same way we would kind of any flip. You're not really getting flood coverage and stuff like that when you're flipping it. But when we go to resell the property, like, okay, I don't want to go through an entire renovation of a house and then the buyer not be able to get insurance on the property, or it just be like really cost prohibitive. So I guess like what are the ramifications to the end buyer of a property that flooded during those storms? That's kind of part one. Part two of the question is there a difference between the houses that flooded because of the actual storm, like storm surge, or just the storm in general, versus a lot of houses in Tampa flooded because of other things, like the city sewage system backing up, issues with infrastructure in the city, properties being lower lying than their neighbors, right? There were some other issues that caused flooding. So is there a difference insurability wise for those homes?
Yeah, I'll address that one. I'll say first. So as far as what insurance looks at, it doesn't matter if the flood was, I'll say, storm surge that came from the bay or just infrastructure. Flood's a flood. So if that water rose up and came in, it's going to be looked at as a flood. And there's no better or worse, what caused it. It just is what it is. It's a flood. The one thing I'll say to look out for when a house does flood, and I'm sure most people in the call are familiar with that FEMA 50% rule, which is if a house floods, the cost to repair can't be more than 50% of the assessed value. And it's actually all governed by the county and the municipality, even though it's called the FEMA 50% rule. FEMA doesn't really care. They're not tracking it. It's all done by the permits. So when you're filing these permits and pulling these permits, the county is keeping track. Like Pinellas County and right on their website, they'll tell you the exact number that you have to stay below. Most municipalities you can call and get that number, but I believe if you look at the property appraisers, the assessed value, let's say it's 200,000, so you have to be under 100,000 to adhere to that FEMA 50% rule. If it's going to be more than that, the county is not going to issue any more permits. You're going to have to either raise the house to meet current standards or bulldoze and rebuild. So if you're going to be dealing with properties that have prior flood damage, that is the most important thing to be considerate of, is that FEMA 50% rule. The one thing, and I actually don't know this answer, I've actually reached out to the county, shocker, I haven't heard anything back yet, is that, because if they look at it on an annual basis, I don't know if the annual basis is based on, storm happened June 1st, is it the day of the loss, 12 months? Or if it's done on a tax season. I believe it's done on a tax season. That would just make the most sense. So on January 1st, everything rolls over again. And so that 50%, it looks at it in that, again, so let's call it annual period. So, my question to the county, which I didn't get the answer for yet, was if someone, let's say it's $100,000 have to stay below. From June to December 31st, they filed, $90,000 worth of permits. On January 1, does it roll over again? And now they give them 100. Because if that's the case, then again, as an investor, you get a second chance, basically, to make sure you repair the house and you don't get subject to this 50% rule. But I would definitely be considerate of that. The second thing is the claim. Even if you're purchasing the house, let's say you're purchasing it for cash, you don't care about insurance, you're just going to get in it, renovate it, and sell it. You'll want to make sure that that claim is closed. So this person selling the house, let's say they had a flood claim for Helene and they had a wind claim for Helene or Milton. You want to make sure that both those claims are closed. Even if, let's say you're as an investor, you're going to be, getting insurance for renovations, which I would recommend. I don't know of a company right now that will insure a house that has open claims. They have to be closed. We have options that will insure a property that was flooded and being renovated. It would have to be an actual cash value policy. I haven't been able to find one that offers a full replacement, but it's better than nothing. But one of the caveats is the claim has to be closed. And this way that new company isn't going to be pulled into that open claim. So just making sure that if you're buying the house that you have, it's called a loss run report. There's another name for it as well. It's just escaping right now, but a loss run report is common, I'll say, vernacular. to make sure it's a report that comes from the insurance company that states the claim has been closed. And you'll want to make sure you can get a copy of that. It usually has 24 to 40-hour turnaround times for the claims department to produce that report. But again, you just want to make sure that that claim is officially closed so that you're not buying a headache where not only are you trying to juggle the 50% rule, but now you have this open claim. The seller's not getting back to you. You as a new homeowner can't close it because it wasn't your claim. It was the seller's claim. So anyone trying to buy that house wouldn't be able to get insurance. They couldn't close. So making sure that all claims are closed is going to be, I'll say, key to anyone buying one of those properties. I can't remember the first question.
So when we go to
so
now when we go to resell the property to another buyer, are they going to be able to get insurance? Are they going to have to exclude flood? Or is the insurance going to be crazy expensive because the house now has been proven that in a bad storm, it floods for whatever reason, right? Does the insurance become more cost prohibitive?
The short answer I'll say is no. So on the home insurance side, so let's say it was wind related. Insurance doesn't, on the home insurance side, they don't care about flooding because there's no coverage for it. So if the house flooded, there's not a concern, I'll say on the home insurance side, there's not a surcharge for it. And even if it's like a normal wind claim where the roof blew off, acts of God are not negatively they don't negatively impact policies. So there's not a surcharge for wind claims. If a pipe bursts and floods the house or the house burns down, they can have surcharges for those claims and they can cause issues. Several companies, we had one like pipe burst claim, they won't insure you going forward. But again, if it was strictly hurricane related, the vast majority of the companies, it's not going to ding a person purchasing a new policy because of those prior claims. There are some caveats where some companies, it's all about underwriting eligibility. If they've had two weather-related claims within a 12-month period, I've seen underwriting get hesitant on a property like that. But again, the vast majority don't care about that because it was all hurricane related. And again, that hits their reinsurance. So again, they're not concerned with the hurricane side. The flood though, one thing to look out for the flood is when it comes to getting flood insurance, if they had a prior loss, there's FEMA, which is the gold standard, but there's also private companies that offer flood insurance. If there's a prior loss, private flood companies don't like it. So the odds are you won't be able to get private flood insurance. Sometimes private flood insurance is less. FEMA will still insure your house. The one thing, again, to be concerned with is if a property, they call it a severe repeated loss home. FEMA works almost like how lenders work, where everything is Fannie and Freddie backed, right? You may have Penny Mac as your lender, but at the end of the day, it's, Fannie Mae is backing that loan. FEMA works with I'll say brokerages or vendors who manage the claim. So you could have Progressive, you could have Right Flood, you could have Bankers Flood. At the end of the day, it's still a FEMA policy. It's just managed by one of those, I'll say brokers. If you have a severe repeated loss, it's managed by FEMA. They can have a surcharge for that. So that's where it's keep prices low. Assuming that seller's flood policy will guarantee the grandfathered rates, guarantee that you're only subject to the 18% rate increase, and you're not, the buyer of that home isn't having to go get a brand new FEMA policy, which would be more expensive after a flood. So that's where assuming that seller's policy is going to be key for just marketability and resale.
Can that policy be assumed multiple times? Like, can I, as an investor, assume it, and then I can pass it off to the buyer? And are they just renewing, like they're grandfathered into just being able to constantly renew that original FEMA policy?
Yep, as long as payments made each renewal or each year, and that policy renews, and there's been no lapses in coverage, that policy will just continue at that grandfathered rate. Again,
Okay.
It's still subject to the 18% rate increase, so it will gradually tick up.
So just to kind of recap and confirm that I'm understanding this correctly, if a property, let's say we had a lot of properties that were not in flood zones, not required to carry flood insurance, but flooded anyway for whatever reason, those properties, typically a homeowner, when we go to resell it after we've renovated it, is probably just going to take out a typical homeowner's insurance policy in which case there's really no impact from an insurance perspective on that property. Only if they elected to take a flood policy, they would likely, actually, I guess if they took a flood policy and that's been the only flood that's ever happened in the house ever, it sounds like it wouldn't be super dramatic for them to even take a flood policy because it's not a repeated loss. They just wouldn't be able to get private insurance. And kind of, I guess
Exactly. Yeah.
it sounds like the more cautionary situation would be if you're purchasing a house in a flood zone, understanding that you don't want one that has had repeated loss or repeated weather related incidents, because that might make it more difficult to insure, over something that may, or it sounds like even if they made a claim for Helene and then one for Milton, that might be a problem. Is that accurate? Like, should we be understanding from the seller, do you only have a claim from one storm, or did you make separate claims for separate storms? Because that could also potentially cause an issue.
Yeah, if on the flood insurance side, if they had, a claim for Helene, claim for Milton, those two claims could put them over. Because I believe it's 3 claims within a 10-year period. I believe is what FEMA will define as a severe repeated loss. So if they had another claim in the past, that could put it over to that severe repeated loss property, and flood insurance will be higher. If they're getting it brand new, they're not assuming any policies, they're just going at it scratch, it's going to be more expensive to get flood insurance. Home insurance won't be affected by it, but the flood insurance would be if they're going at it from scratch.
Okay, awesome. Thank you.
Yeah, great question. That's, I know, especially after these last storms, that's been one of the questions that we've gotten most of, and it's unfortunate for everyone. I know some of the calls going through some of that right now, and it's definitely stressful, and it's awful. There are actually some things which I thought were pretty neat. There's no discounts for them, but if you Google like flood barriers, there's I've seen it before. It almost looks like a inner tube that you would put around your house filled with water, and it creates a several foot like dam. I've also seen these barricades that are L-shaped, then they kind of just link together. And as the floodwaters, actually around Tampa General, they had those, just on a much smaller scale for residential. Floodwaters rise, the weight, is put on the outside, so it won't tip over. And again, it's just a way to protect your property. There's also flood barriers I've seen you can put over openings like garages. So let's say it's a slab house, block slab house, and you just have a door, couple, 2 doors and a garage door. You can get a 4 to 5 foot barrier that goes across to prevent water from just getting in. So again, there's no discounts for them, but if you are dealing with a property that had a repeated loss, maybe it's a good idea to have that installed. They're a couple $1,000s, I think, to do, but it might just give peace of mind to someone who's purchasing it that it did repeat some losses, but here's a preventative measure that we put in place.
I got a question, Ryan. So a lot of us are either flipping older homes or we own older homes. And when I say older, pre-1940 bungalows. So, my rental properties, we've probably doubled in insurance. My primary is doubled in insurance. When you say that there's some new insurers coming to the market, is that going to have any impact on us? Because essentially the majority of them were under Citizens and then they got depopulated to private. So like Slide and Florida Peninsula. And do you see any relief for us with these older crawl space homes?
I do, and it may not be instant. Again, the older homes, unfortunately, just aren't as desirable as newer homes when it comes from an insurability standpoint. So there's not a lot of companies chomping at the bit to compete in that space, but I do think it'll gradually happen. I think the newer construction will be almost, I see, instantaneous. You'll see the results a lot faster, especially with Citizens and their takeout program. A lot of the new companies coming in, that's how they get their foundation policies, is they'll do Citizens takeouts. They're going to be taking out the best of the best when it comes to Citizens. Citizens will require them to take some of the least favorable. So that's where you may get lucky and get kind of snuck into one that has, better rates. But I will say a lot of the new companies coming in, they don't have a lot of that bad claims, I'll say debt or battle scars from the roofing fraud issues. So the odds are, even though they may not be priced for the older homes. On the pricing models, like maybe they're geared towards 2010 and newer. They still may be more competitive than your current company for your 1940s home. I would say it doesn't hurt to shop. You don't have to get new inspections to get a quote. Have it reshopped. See if there's something else there that's more competitive. And if so, then if it's saving $100, I would say it's probably not worth the hassle, because you're going to have to get inspections. That new company could find something that they just don't like, and they're going to cancel you, and you can't go back to the old company. But if the savings is significant enough, maybe worth looking into and actually switching. If you're with Citizens, you could ride it out, because the odds are you'll be taken out of Citizens by a privately held company that'll be less, especially with these new companies coming in, because again, that's how they're going to fuel their book, is by doing those Citizens takeouts. So you can kind of, I'll say, play it two different ways. Kind of hold with Citizens if you have a Citizens policy, see if you get taken out by a cheaper option, or wait until some of these new companies come in, reshop, see if they're competitive, and if so, jump ship from who you currently had and go to that new company. Does that kind of help? Does that answer the question?
Yeah. Is there any way to mitigate, like you just said? So let's say I have Citizens and I barely got by with Citizens. And now I'm looking at shopping other policies, but we won't know if they really cancel the policy till 30 days after. Is there a way I could keep my original policy, shop other guys, sign the paperwork, pay them, and then give them their 30, 60 days due diligence before they drop me? Or you have to let Citizens know right away, or whoever?
So technically, so you can't have a property insured by two companies simultaneously. If you get a new policy and you forget to tell your old company that you got a new policy, and it just magically went past the underwriting period, which is 60 days, so the new company is actually taking you, you can go back to the original company like, hey, I forgot to tell you, I actually have a new insurance policy. Here's my proof of coverage showing that you were insured during that time, and that other companies, so Citizens in this case, would backdate the cancellation and refund you back, to that original date. There's some companies, I say that with an asterisk, that they will only backdate 30 days. So, let's say you waited 60 days. There's a couple companies out there that I'll say got wise to that, and they'll only backdate 30 days. So just be mindful of that. You won't get the full pro refund, but a lot of times it's worth that extra 30-day risk that you're double insuring. But technically you're not supposed to have two policies at the same time, but I will say it happens all the time where people forget and they go back to their company after that policy is officially cleared underwriting, and they cancel it, and they just backdate the cancellation. So I don't know if that helps, but essentially that's the answer.
Yeah, no, I appreciate it.
Anybody else? Last questions for Ryan as we wrap up. Ryan, this has been super helpful for me. I'm sure everybody in the group got the same value from it. Thank you for your expertise and taking the time to answer all the questions. I'm glad you put your contact information up there, so I highly recommend to the group. If you have insurance needs on one of your projects, reach out to Ryan first, give him the opportunity. Again, Keely and I found his team super responsive, and they always find a way to partner with us to give us the best possible pricing. So, Ryan, thank you.
Thank you,
so
Ryan.
much for the time today. We appreciate you.
Thank you. Yeah, no worries. I really appreciate you guys. And you got any other questions? Yeah, feel free to reach out to me afterwards. I'm happy to help.